Hello, everybody. A warm welcome to another edition of our very successful Across Retail Talks. My name is Reinhard Winivater. I'm the publisher of Across Magazine, and I'm very pleased that so many people across Europe are here today. Our today's topic, in my opinion, a very, very exciting one. We will talk about investment strategies in retail real estate. A top-class discussion group is ready. Klaus Striebich will, as usual, lead this discussion as an expert moderator and my master of ceremonies. What's important to mention is that you can or you should ask questions during the discussion by using the chat function. What we will do is that we will send out the summary of this talk with tomorrow's newsletter, and this discussion will also be part in our next print issue, which will be published end of June. So that's it from my side at the beginning. I now hand over to you, Klaus, and yes, the stage is yours.
Thank you, Reinhard, and welcome also from my side for our second Across Retail Talk this year. And it's fantastic to see this round of real big decision makers in our industry. So today's talk has to figuring out what takes place in retail real estate market when it comes to investment strategies. When we read the newspapers or the media, retail real estate industry is bouncing back, which is good, and there's maybe a reason why. All the followers who have listened to the past talks have seen that especially outlet malls or retail parks are improving, and maybe there are more retail real estate classes which are developing well. My favorite question when it comes to retail real estate, and you made these already, is the discussion about the future of retail. And the question is, where do we win as a retailer or a retail asset, and how do we play with it? So that should be figured out, and we want to ask about the origin, the status, the development, role, strengths, advantage, disadvantage, opportunities, and outlook for the future when it comes to investment strategies. Therefore, I have some provocative statements for my panelists. There is enough money in the market, but does it know where to go to? Some call it life cycles, others name it following the herd. Is money a kind of stupid? Investors are pure number crunchers and decide purely on facts and figures. And that question will be answered by this round. I have invited a very great group, and I would love to introduce you by alphabetical order. And I will start with Henry Eisenkopf from Union. Henry, welcome. Not your first appearance here. And I'd like to have you again here with us. And please introduce yourself and say something about Union Investment, where you're from.
Thank you, Klaus. Indeed, yeah, my name is Henry Eisenkopf. I'm with Union Investment, and it's one of the leading asset managers in Germany, especially in mutual funds and also real estate investments. We do focus on just creating investment opportunities for privates, but also institutional clients, where we manage several funds throughout different fund strategies itself. So it's not one portfolio, it's several portfolio with different strategies. And as part of Union Investment Real Estate, we do manage a quite diverse real estate portfolio across the globe, but with a clear focus, let's say, on European investments. We have roughly 50 billion under assets. And within the retail investment team, my role as a director of transaction shopping places focus mainly on investments, but also disinvestments of shopping centers in Europe.
Thanks for that. I think buying and selling is on the same level, so therefore it's good to talk about both ways. We have, for the first time, Rhys Evans with us. Rhys, we know each other since years, but now your first appearance in our crosstalks. Welcome, Rhys, and say a little bit what you're doing with Pradera. We are curious to hear.
Thank you very much, Klaus, and thank you for having me. Good afternoon, everyone. I'm Rhys Evans, Chief Executive of Pradera. So Pradera is a 26-year-old business that purely specializes in retail investment management, anything under the banner of retail, but nothing other than retail. We have over 5 billion euros of assets under management across 58 properties in 9 different countries with a total of more than 70 different capital partners. And we're headquarters in London, and we have management offices as far west as Dublin and as far east as Istanbul. We provide a full scope of services to our clients, ranging from acquisition-led services on the way into an investment, all the way through to the asset management, the leasing efforts, the development management efforts, all the way through to the disposal strategy of assets. My personal background, I've been with Pradera for 10 years. I actually joined Pradera in Shanghai, where we had a large portfolio of shopping centers under management. Prior to that, I had been in the Far East with a business called Swire Properties, which is one of the main Hong Kong developers. And I moved back to this part of the world in 2019 and have performed different roles with the company before becoming chief executive last summer.
Sounds like a perfect timing and a fantastic career. Thanks for being with us, Ries.
Thank you.
My colleague from the advisory board, Stefan Hoffmann from Ambus Real Estate with us. Some of you know him already, but you should tell the audience what Ambus and you are doing.
Yeah, thanks. And yeah, I'm really excited to be back and speak to you again, and also to my fellow panelists from across Europe. So my name is Stefan Hoffmann. I founded Ambus Real Estate about 12, almost 13 years ago. And what we do is we advise institutional real estate investors in their capital allocations. We have a strategic asset management advisory arm where we work on standing assets, but we also advise in transactions that may be brokerage services, but also services on the buy side. We do corporate M&A. That means we are, in that case, not selling or acquiring properties, but platforms managing properties, for instance. So one of the examples you will be familiar with is last year's disposal of Unibail-Rodamco, a third-party platform in Germany that got sold to Sonae Sierra, which is just a recent example of a transaction that we worked on. And the fourth thing is, which we've just launched, is debt advisory, because we've just realized that when we find equity in the current market environment, it takes a while to bring debt to it. And in order to facilitate transactions and speed them up, we do that in parallel nowadays.
Super. Love to hear your views on our topic, and welcome back in our talk. A second newbie, and I'm happy to have him with us, is Toby Smith from Axis Capital Partners. Welcome, Toby, and let's give us a hint what you are doing the whole day.
Thanks, Klaus. Very pleased to be here. Thanks for inviting me. And yeah, I look forward to sharing with you a little bit about Axis. We are a privately owned investment management boutique based in Madrid, here in Spain. We, like Ries, provide investment and asset management services to our clients all across Europe. Investors looking to enter the retail sector, but without necessarily the capability and expertise to do so. We are a young business, 2 years old, and have about 200 million under management in Portugal, Spain, and the UK, and are looking to expand across other European countries. At a minute, I'm sure we'll come to this. We're seeing interesting opportunities in Germany and Italy, and are active there also. So yeah, our focus is on being a specialist operating partner, completely dedicated at the minute in the shopping center space, where we're able to leverage off, many years of expertise and experience from my days and my business partners' days at ING Real Estate Investment Management and CBRE Global Investors.
Thanks for that, and hope you will enjoy the session with us. And maybe we see us more often in the near future, Toby. So great. Coming back to my first, let's say, provocative questions, and if you can start with that, Toby. My claim is there is enough money in the market, but does it know where to go to? Is that right, or what is your view on that?
Yeah, listen, I think as a retail specialist, we're delighted to be on people's radars again. I think from investor surveys, you can see that, investor interest in the sector is growing year on year. It's obviously been in the last few years dictated by those early movers, those able to take a kind of higher risk or those with a higher risk appetite. But the surveys also say that those with retail assets are also very keen to expand their retail ownership. So, I think those early investors that have been brave to invest in the sector are seeing the benefits, the resilience of the cash flows, which attracted them in the first place, and they're keen to actually expand their footprint. So, yeah, we are no longer in the doldrums. Clearly, logistics and living sectors hold a dominance, but I think from a retail perspective, we're very excited about the growth and opportunities that the sector possesses.
You have mentioned a word which is named resilience. Is that one of the major topics currently in the investment market when it comes to the, let's say, capital flow? Is resilience a main argument to invest in retail real estate?
Yeah, I think operational resilience in CBRE's, investor surveys was the m most high reason why people invest in the sector. And I think we've always known that from the operator side. And I think the first players that came in were specialists who could see this. So yes, I think that is it. Everybody, let's say a high percentage of people coming into the sector are attracted by the yield. And that yield needs to be resilient. It needs to be stable. And that's the first question we get is how resilient is that yield? So being able to demonstrate that with a lot of the data that the sector provides is fundamental to the first bits of work we do on any investment.
That's a perfect bridge maybe to Henry when it comes to resilience and let's say stable investment and returns. Is Union seeing this, let's say, topic when it comes to their investment decisions?
Yeah, thank you, Klaus. I think that's an important question to ask since we are core investors, and especially for core investors, stability and resilience within the cash flow is just very important. And within retail, and I think Tobias touched on this as well, is you do have a lot of data points. You don't have that in all the other real estate asset classes. So we do have a quite long track record within our European portfolio. We see, let's say, where markets are rising and the opposite. And this is a clear, I think, advantage, as Toby said, for the specialists, for the ones that do work in the.
Oops. And it was a bit exciting. We have lost him. Hopefully, he's back in a minute. So let's follow up with Reese. You have bought something new in Germany. Is resilience one of these factors you have decided to go to a German market again to buy a big asset? I think we can spoil that it is Scorpius. I think everybody knows it meanwhile.
Yeah, well, funnily enough, I'm actually sat here because the quarterly investor meeting was being held this morning. So, yeah, look, I think taking that asset or taking this asset as an example, there's no doubt that the resilience and the robustness of the cash flow was one of the things that attracted us to the asset. I think that regardless of the cost of capital or the type of risk that you're seeking to achieve through your investment, it doesn't really matter across the spectrum of value add, core plus core investors. I think there's a given that the underlying cash flows need to be robust and resilient. And then if there are asset management initiatives, then they are additive as opposed to the thesis that underpins the investment. So there's no doubt that resilience and robustness is an absolute must across varying costs of capital.
We will discuss later when it comes to comparisons with other asset classes, maybe. So welcome back, Henry. Hope all is fine, technically solved. Have you anything missed before you have been gone away?
Can you guys hear me again?
Yeah,
yes.
I can hear you.
Okay, sorry, wasn't aware. Yeah, sorry for those technical issues. So what I was trying to say is basically, let's say, coming back to your question on resilience, and I think this is especially important when it comes to core investments. And I think the advantage of the retail real estate sector is that we do have a lot of data points, let's say, to provide where we are in the cycle, to provide where and how tenants are performing. And I think that plays quite well into the question on how stable is your NOI, how stable is your yield that you're buying into and that you might be also want to exit at. So I think resilience is what everybody's looking for, especially in a world where we do have a lot of volatility in other asset classes that you don't want to, let's say, have in a resilient underwriting. And I think this is one of the advantages that we have within the industry.
Yeah, perfect. I would love to forward it to Stefan because what I would love to understand and dive a little deeper is the data points you've mentioned. The knowledge about retail is existing for quite a while. So that's nothing new, but maybe it's a bit more transparent on the one hand, could be the case. On the other side, how does that, let's say, influence, I would say, the life cycle of investment strategies in retail real estate? There will be ups and downs, I suppose. Stefan, what is your experience in that when it comes to investigation, data points in retail real estate to guide the investment streams into the right directions?
I think it's super important, and there is one statement that I hear a lot on industry conferences that retail is an intransparent asset class, which I just don't agree with. Of course, we have confidentiality, and we cannot publicly share the sales data of certain tenants, but we have that data, and we are allowed to look at it. It's agreed. Investors have that data because managers want to improve the assets, so they need data in order to see whether the initiatives work or don't work. And we call it KPIs, key performance indicators. And I think the good old KPIs are still rock solid KPIs and super important. We may be better today in assessing them, in finding patterns with the help of AI, for instance. But to start with, I would always look at footfall and sales. That's an important bit of information, and I would put it in a historic context. And when we now come to the asset class, I think we have had an enormous stress test. As a society, we have a lot of stress tests that we go through. But as the asset class, we've had one particular stress test, which was COVID-19. And so what a lot of investors do nowadays, they look at how did an asset perform in 2019 and how does it perform today? And it gives you an important direction, because there are assets where footfall and sales are today, 6 years later, still below 2019. Something got broken in this stress test, and you want to mitigate that risk and understand what happened. You may need to downsize the retail share or whatsoever, or it's broken forever and it will turn into a dead mall over time. The second thing is you could have, footfall below 2019 and sales above 2019. The other combination is more unlikely. Yeah, but people got used to shopping the internet, to stay in their environment. They go less often to the inner city. So footfall could be below 2019, sales could be above 2019. That's not too bad, actually, because it underpins the rent levels that you've had, and there is stability from where growth can kick in. The third thing is you can have assets that have footfall above 2019 and sales above 2019. And this is assets that we call resilient. This is assets that have proven that they have come back, and there are quite a few in the market. And it's our job to analyze the data points and to guide investors or guide sellers so that they know what they have in their portfolio or what they can have in their portfolio if they were to sell or to acquire that particular property.
I love to remain on that topic a little bit, if you allow. So I love this third one, which is higher footfall, higher sales. I would call them gems and jewels. So maybe that to differentiate a little bit. But after having transparency in that assets, that's for sure and necessary. Don't we have the I would say necessity or obligation to dive deeper with more KPIs? So you mentioned it somewhat. It could be the case that we have less footfall but higher sales. Maybe there's a reason why. Or maybe there's a change in the usage. So if you sell food, there's a difference compared to fashion. We talked about some new brands appearing currently. I think the necessity to dive deeper and to find more KPIs in details is necessary to keep these assets alive. I see Reese saying yes to that question. Reese, do you do some more investigation, diving deeper into details with that?
Yeah, we do. So we've actually, over the last few years, we've made the decision to start an in-house data team. So we've got an in-house data team of three people, two of whom focus on consumer observations. One of the big things that we do in analyzing all of the potential patterns that Stefan speaks of is to look at, okay, what are the prevailing patterns or the recurring themes that are happening across the different categories of trade that are within a property, and that coupled with credit card data in certain markets where it is available can reveal really rich observations around where is there remaining headroom into which the center can eat. So, for example, if we've got demonstrable further demand in health and beauty, and our area is underpenetrated, then there's demonstrable room to grow into that category, and that will apply to all of the varying categories that sit within a scheme. So I think that there's another level of sophistication that's become apparent in our industry over the last 5 years, and that's also because all of the different capital partners that we work with, and I would say the industry, the investor industry at large, has become a lot more sophisticated in terms of how they understand multi-let retail property. So I think the last 5 years has revealed another deeper level of sophistication in terms of how this type of data is analyzed.
I feel this is a kind of a change in the industry, that the knowledge and the experience in how that asset works or the user work and what they need for their success has to be known and analyzed and, let's say, discussed. Toby, you have mentioned in our pre-meeting that you have just opened a new store of one of the front runners in the fashion. Maybe naming? It was the opening of a Lefties.
This is it here in Portugal.
Okay, perfect. Have you done something like this deep dive what Reese or Stefan have mentioned to make that a success for your retail asset?
Yeah, I mean, I think I would say that I concur with everything the guys are saying. We're working in a very organic sector, right? Every shopping center lives its own life. Every shopping center is unique because of no catchments are the same. So, I think and the retailers themselves, they do fundamental consumer research into their own catchment. And the likes of Inditex are right at the kind of front of those, that analysis, the depth of work that they'll do to understand that in this case, in Portugal, we knew we had what everyone talks about, a dominant asset without any kind of competition. We just choose assets where if an Inditex or any other brand is looking to kind of expand in that city, this is the asset they'll choose, right? This is the place that they want to be. In this example, we were able to extend their footprint by another 1,000 odd square meters, right? So they choose where they want to be, and then they consolidate their footprint there. And I think that that's what we're seeing across Europe is, brands selecting and being very specific about it. That bifurcation of the sector, winners and losers, has been very well publicized. But you really see it in assets like this where brands, start to take over other space from poor brands or poorly performing brands. So you have a win-win. You're consolidating your exposure to real winning brands, and you're also replacing those that, perhaps aren't doing the sales densities that when you compare it against the databases that, Reese refers to, you can see that they're not, let's say, pulling their weight relative to the sector, relative to the asset. So from an asset management perspective, those are the ones we're targeting. And, to be able to do deals like we've just done at Lefties that opened today, it's great. It's great for us. It's great for our client. It's great for the customers. They're queuing up to get in there, which is first and foremost our priority.
That sounds great, and I wish you lots of success with that asset. But coming back to the number crunches I've mentioned at the beginning, so does not sound like a high rental payer, Lefties, Inditex Group. So how could you manage that from retail real estate as a perspective to make it a success when it comes to yield, profitability? What is your secret of success?
I don't think there's any, secret potion that we're taking. This comes down to the underwrite. I think that when we're acquiring assets, we're very diligent. We're very focused on the data. You understand that, from that analysis process and when you're making offers, the type of business plan you want to implement. So in this case, we knew that there was an underperforming tenant that's not hitting the level that we need to. We understand the rent they pay, and we understand what kind of level, a lefties in an expanded footprint would pay. So, that also comes with a contribution from the landlord side, which is, not to be underestimated. You have to make that work as part of your business plan. There's, very important investments from a landlord perspective that you have to make to keep this asset as successful as it has been in the past. These recoveries and footfalls, recoveries and sales, they don't happen by their own. You have to be investing in these assets. And, at the end of the day, if there are too many of these projects and your rents do fall, you're not going to hit your returns and you can't be competitive. But in a case like this, we were able to deliver this business plan, and still hit the returns of our clients. So in that case, yeah, we did enjoy the potion.
So may I conclude that a long-term view is necessary from the investor side to secure this, call it resilience again, and to make a decision profitable? Because many investors I've met in the past, not all of them, to be honest, but some are always a bit short-termed in their view, and
Oh, of
that
course.
drives me crazy.
Of course. I think, people are attracted by the yield of the sector at the minute, as I was saying at the beginning. But it's very hard to, and I would say prime yields are, probably 200 basis points off their peak levels across Europe, and certainly 100 basis points above their long-term averages. So the entry point from a purely a yield perspective is very appealing. Now, to underwrite that you're going to exit at previous peak levels, it is not something that, we can stand behind or an investor will accept. So, you have to find ways over the long term to grow your NOI to create that IRR, right? So we're not looking at a quick spin here on any of our investment opportunities. There'll be even some of the opportunistic capital that we work for, will have a minimum 5-year business plan. And if they can underwrite as little yield compression as they can, that's a plus, right? And if they get it, it's an upside to their return. It's not something that people are building in from day one. And even the most core asset that, we've all bought, there's always stuff to do. And, really to demonstrate and prove liquidity, which is another big question for investors. Who do you sell to and how can you exit this investment? You have to, come in at the level and then undertake your work to make that asset better by the time you leave.
Super, thanks. Henry, you are representing a big portfolio, a very big portfolio, and a long-term investor. How's your view on that from Union's perspective?
Indeed, I think it helps a lot if you can have that long-term perspective, and this is what core capital should have by definition. And this is, let's say, we do look more at a 10-year plus business plan, not because we don't want to exit earlier, but because we see that it takes time to build, let's say, those assets, to improve those assets, and to make the right choices. And you have to invest in those assets quite heavily as well over a long term, as in any other investments as well. But it takes a quite strategic view to do that. So it is, as we said from the very beginning, indeed a bit of a number cruncher situation. But I want to just quickly come back to that, because I think, however, that there is a lot of numbers that we have and a lot of track record that we can show. I think we must be taking into account that it does really depend also on the past experience investors have. And these are coming back to the, let's say, various hurdles they have when coming back to the market. And we have to take that into account. And as Toby said, I think there's a quite favorable market entry situation that we have, giving yields, giving stability of the cash flows and the operating strengths of retailers that we see in various markets. It's in the end still, let's say, the people who make the decision and not any IA Roberts, just purely on facts and figures. And to transport that information, I think this is crucial for every investment department and disinvestment department throughout the industry. But again, yes, as a core investors, we have the ability, let's say, to form that long view, which also means that we do have long-lasting relationship with tenants and also to grow them into an asset, have them as a little store, looking at the turnovers and grow them, let's say, over the course of 5, 10, 15 years into flagship stores over that course. So that helps.
Thanks, Henry. We have the first question from the audience, and that fits to our discussion currently. So I will read it. Came from Pavel, my friend. So he asks, banks are asking for more evidence of how assets actually perform. As investors, what granular data are you asking for today that you were not asking for 5 years ago? And what data would you want but cannot get today? Interesting question. Stefan, do you want to start with it?
Yeah, I wonder whether it's really new information other than, AI assessments. But you 5 years ago, you already looked at the two easy things that I mentioned, like footfall and sales, but then you drill deeper. You go to, and this is what makes particularly the asset class of shopping centers or the asset class of outlet malls very complex. But it's also possible to find in that data to win certainty about the direction these assets are heading. It's easier in high street properties where you have less than a handful of tenants, sometimes one, or in a retail park where you may have between 8 and 15 tenants. So the data you want to drill down to is a tenant by tenant sales performance, but also occupancy cost ratios. So where the cost evolution of the operation of that store in the very property will be taken into account. And you will not apply the same ratios as you indicated, Klaus, on all of the tenants, on all of the different offers. So sports needs a different ratio compared to food and beverage, for instance, or furniture can bear completely different margin compared to electronics or a drugstore. And this is what we want to understand. And I think more and more people want to understand that. It's probably new that more and more people want to understand that, but that data was available 5 years ago as well. What may have changed is the frequency of, how often you can look at it. In theory, it's possible to have that daily. It's the only thing is markets are completely different. In some markets, retailers declare on a weekly basis. The sales are in their system in the evening when they leave the shop. It's in there. So in theory, it could be possible to make live data available. Is it necessary? Not really for the landlord, but having it only 3 months in advance, with a 3 months delay, or even only annually, that's probably too late. That's probably too late. So what you want to have is, I would say, a monthly data set of what happens in the individual stores. You build that up over a quarter, over a year, over the whole period. And that helps people to take educated decisions.
Yeah, thanks. I think we talked about transparency and, of course, also the discussion about what kind of data are useful and what's not. That's absolutely an ongoing one. Reese, is there any data you would love to ask for these days, what you can't get currently, or are you fine with everything?
No, look, I think it's been widely accepted for many years that our sector is a lot more operationally intensive than many of the other sectors. I think one area where it's somewhat of a holy grail, possibly for us as managers of particularly large shopping centers, is to understand if we can get to the point where we're triangulating the incidence of spend with a particular type of customer's presence in a store, that then allows us to actually grow a lot more rich observations and an understanding of our customer, because ultimately that's key to everything that we do as managers of retail destinations, right? We've just got to keep reminding ourselves that our job is to maintain relevance for the customer, and that can range from a needs-based retail park all the way through to a shiny out-of-town shopping center. So I think that for the latter type of category, I think, yeah, as I said, the holy grail would be just to understand a lot more about the incidence of spend and the customer profile, because then that eventually allows us as managers to create a better offering that better suits our customer. I think that's one area that will become more and more interesting.
This way, you speak a bit more about, you speak now a bit more from the perspective of the operator and the operational manager of the asset, and probably less about the capital that is basically behind the ownership of this, right?
Well, I mean, yes, in the main, Stefan, but interestingly, I think that if you are getting into assets that are operationally a lot more complex, then inevitably a lot of our sophisticated capital partners will want to understand that detail as well. So yeah, I wouldn't bet against it. Them wanting to understand that as well.
Yeah.
Super. I'm afraid we have a very interested audience today, because next question has arisen. So I will from Philippa. So thanks for that, Philippa. Her question is like follows: how do you measure the ROI of community building initiatives, experiential concept, and destination making investments that do not directly translate into rent increase? I love this kind of question. Who wants to start with the answer of it? How do you measure the ROI of these kind of initiatives which does not directly translate into rent increase?
That's very difficult. Toby, you go first.
Yeah, I think, listen, I'll give it a shot. It's very difficult. What do you think, Reese? No, it is it is a challenge, right? But I think it's maybe spinning it the other way. What's the cost of not doing it? This is something that's in our template kind of modeling. There's always a line for placemaking now. I think this is something that you simply have to do. The customer is very demanding of this. I think as a shopping habit, they're not just going for price anymore, right? It's all about kind of value for money. And some of the best operators, as we've already spoken about on the call, find ways of selling their products at a low level, at a cheaper price, but in an environment of, almost luxury, right? And I think that doesn't work if the mall hasn't maintained that level. So I think every manager now, every owner of shopping centers needs to factor in a cost of CapEx. What that is as a percentage of price or rent is very dependent on the state of the asset today, the age of the asset, the type of tenants you're trying to attract. But I think it's a necessity. If you don't do it, can you attract tenants? Can you maintain rents? Can you exit that asset? And I would say kind of no, 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 right? I mean, it's one-way travel if you're not investing. I think in the past, we were probably guilty, as many others were, of buying assets and looking at OCRs and taking tenants to kind of a higher rental level, but still affordable, and not investing as much in assets as we do today. I think it's been a big sectoral shift in line with kind of consumer change that, placemaking is what it is today, and that experiential need, that a need for an emotional connection with your visitors is fundamental.
Is this the more entrepreneurial part in this industry? Means it's difficult to predict, but there is, of course, a need to do something. Henry, what's your view on that, if you want to comment?
Yeah, indeed. I wouldn't really say so, because to be honest, also if you do lease a unit to a new brand, you also have to believe in it, right? It's maybe market entry for one of the assets that you have. So you have to also believe in their business plan. So it doesn't really differ that much, I would say. It needs to fit to the customer base that you have, and you need to be aware what kind of customer base that you have. And you can go classically back to, let's say, customer service and so on. But you also see, let's say, right now, quite direct response online. People like to chat about, let's say, their markets, where they do shop, where they do spend time, where they eat. Everybody's, responding unasked, so to speak. And you can really use that and see, let's say, in which direction do you need to go? Does that concept work or not? Where do we need to improve? And I think this more or less applies the same with, signing up new brands for your shopping center. So it's not new, but indeed you have to invest, and sometimes you make the right decision, and sometimes you need to readjust.
Yeah, thanks for that. I would love to talk with you a little bit where the money will flow means geographically or maybe into the severe specific retail real estate asset classes. So Reese has started now with a new big investment in Germany. I heard that Toby is also discussing or considering investing in the old mature German market, which sounds nice, but there must be a reason why. Which location, which geographic region, whatever, is currently the most interesting one? Is there a hidden champion, or what is the reason coming back to an old matured market? Reese, you want to start with it?
Yeah, sure. I mean, look, Klaus, does your question specifically to allude to Germany, or just a more broad question around
A bit more broad. So give us a hint what kind of, let's say, geographic region fits best to your point of view, and if you want to say some words about Germany, why not?
Yeah, no, like I think what we all forget about the wonderful sector that we work in is that there's a continuum of complexity, if you will, in terms of what different investors can get involved in. So if I look at our portfolio, we range from long income grocery investments with pension funds all the way through to 200-unit shopping centers with both core and private equity investors. So there's something for everyone. As another defensive answer, Klaus, I think that in reality, I can't think of one country that we're in where there aren't opportunities to potentially acquire assets at aberrational levels, at levels that probably that many of the participants here today haven't seen before. So I think as a general statement, I think that yields are aberrationally wide. I think Toby's home territory, Spain, is obviously getting more expensive. I do think that the German and Italian markets are interesting, and contrary to popular belief, I think the UK remains interesting because the UK consumer and the spend that we can see coming through our shopping centres, it's a very robust market, and the UK consumer is very resilient. So I would call those out as particularly interesting markets, especially as far as shopping centres are concerned.
So thanks, Reese. Stefan, you are supporting investors with their, let's say, global invest strategy somehow, and you're a bit more, let's say, general on that basis. What is your view on geographical investments? Where and what kind of investment class is best? Shopping malls, outlets, retail parks, single standing units, north, south, east, west. What would you comment?
Yeah. So we are supporting indeed global investors, but we don't work globally. We work in Europe. But we've worked in 12 different countries in Europe. And at the moment we work in 4 on live projects, which shows where the money is or where the money goes, but that doesn't mean it doesn't go to other countries. So we work in Germany, we work in Austria, we work in Portugal, and we work in Spain as we are having this conversation this year. And but when we look at the last 4 or 5 years, Toby did a deal in Munich in the middle of the German gas crisis, December 2022, a deal that closed in 23, which was the acquisition of the PEP shopping center. The macro setting for Germany with the gas dependency towards Russia, at that point in time, terrible. Still, he picked one of the very best assets that you can pick in Europe. I don't have any insights, but I think the new ownership should be pretty happy with the performance of that asset. Reese, you bought in Palermo. It's in many phases, it is a non-institutional investment location. In some phases of the market, people also move money to southern Italy. Normally, they concentrate on northern Italy. Sometimes they avoid even Italy as a whole. I think they did a fabulous deal in Palermo in the next year after Toby's deal. I think Henry did probably the deal of the year last year, selling a shopping center for Union. I can speak about that because it's all public. Yeah, the fact is public. They sold a shopping center well above valuation of Union Investments books. I think it was really the deal of the year on the sell side. Congratulations also to the CBI team that worked on it, and Henry and all of them. It's in Czech Republic. such a small market. If you now ask me, where should they go? Where should they go with their money? I think Czech Republic would not be high on my list. But somebody did a fabulous deal in Czech Republic last year. Ries and Pradera did another great deal in Germany, which undergoes a structural change at the moment. There's massive pressure on our politicians to put reforms in place that, the whole population is only waiting for it. We embrace it in the meantime. But it takes a while for these reforms to be passed. This is also why I guess the cap rates have moved out a bit, but they are way above the long-term equilibrium yield. So it's a rare situation at the moment where you can snap up an asset in the German market at a price level that you've normally have achieved in an emerging market. Yeah, so I would say Portugal, Spain, Italy, super interesting markets. Poland, super interesting market. But the countries that I've just mentioned, they can be very interesting on an asset level. And I think with retail in particular, the larger the property gets, it's less about the country or region. It's really about the very asset. You can buy a rocket in a location where the macro setting is suboptimal, but it can still be the very best retail property in that region or country, and it can be a very good investment.
Thanks. Great coverage for that question. So we have a fantastic audience, to be honest. I have next questions here in my list, and I would love to go ahead with these before running out of time. So maybe that fits also to Henry's decision-making processes. So the question is from Tirthankar. So thanks for this question. He asks, how important or valuable is the branding of a shopping center or retail destination to a customer, and where does this sit in your priority list when considering investments in your assets? So how important or valuable is the branding of a shopping or retail destination when it comes to your decision? Henry, would you love to try to answer this?
Sure. And let's say looking throughout our retail portfolio with shopping center, but also retail parks, branding becomes more important, but not only, let's say, for the customer itself. And sometimes you have to be quite careful, let's say, in rebranding, right? Because everybody has a lot of ideas on how to rebrand an asset and how a new logo should look like to make it, let's say, closed brand and experience. But from a customer perspective, and usually you have to look at the local catchment. They go there every day because it's their local hub. That's where they like to go. And people are not always, let's say, absolutely welcome to new changes. So you really have to take the right decision, let's say, when you want to change a branding or when to expand a branding. We do this from time to time where we think it's suitable, but this is, let's say, operational. If you look at that from an investment perspective, I think it does also play a bit of a role because a name gives also, let's say, a function for institutional investors, a function for banks and finances. So if you can establish such a brand where we do have a couple of, let's say, examples in our portfolio, just as Alexa in Berlin, everybody knows Alexa in Berlin. You don't have to be there in order to know that name and know that this is, let's say, a prime shopping center destination within the capital of Germany. That said, you still have to, let's say, look at the local customer and the ones that are making the real turnover within your assets. So it's a question that you can't, let's say, answer straight or give a straightforward answer to.
But it's a big yes, I suppose. So there's another question maybe that fits to Toby a bit from Sebastian. He asks, apart from yield, what KPI, key performance indicator, should a brand place number one ranked in your opinion, based on your experience and expectation in your different roles? He said it's a simple question. I don't think it's simple. So apart from yield, what kind of KPI should brand place number one ranked in your opinion?
Should brand place? What was that? Sorry.
A brand place or your asset or your shopping mall, your investment.
Okay. Not yield, not only yield. Well,
what kind of KPIs?
From an investment perspective.
Yes.
I mean, there are so many. We're so rich on data points, but as Stefan said at the beginning, I think with shopping centers, we kind of start with normal KPIs in terms of footfall, sales densities, OCR levels. We compare it against the previous years. I mean, I think that we would always go 3 or 5 years back to be able to look at trends and evolutions of those KPIs. Yield is relevant, but rent and yield sit together. Capital values per square meter also very relevant. So I think it's, yield is one that catches the eye perhaps, but in the context of many others, I think rent is fundamental at the minute. And whilst yields have corrected, so have rents. In the UK, for example, you're looking at a kind of 40%, up to 40% reduction in rents. On the continent, there are other markets which, CPI has taken rents to a very unaffordable level. So that yield can be quite misleading if assets are very over or under rented. So yeah, I think it's a context, a combination of different factors. Rent, capital value per square foot, obviously linked also.
In the marketing world, there is a KPI called Net Promoter Score. You have maybe heard of it, which is not easy to measure, but often used. Something you would consider?
Yeah, I think it's always there in the data packs you get. Any marketing presentations that we receive quarterly will look at your Net Promoter Score, your effect on Net Promoter Score. It really depends on the type of asset, Klaus. There'll be convenience assets where Net Promoter Scores and marketing budgets are much less. Your impact on social media forums will be much less because of the loyalty that local customers have. And you're talking of drive times of, 5, 10 minutes perhaps. On bigger regional malls, your Net Promoter Score on an asset we used to manage in Zaragoza and Puerto Venecia is fundamental, right? And we'll look at an evolution of that Net Promoter Score over the course of the management. And it's one of these KPIs that will hold, marketing teams to be able to get some kind of ROI on the marketing costs we're spending. So yeah, it's, again, it's an important piece of that, a way of kind of measuring success on marketing costs that you're investing, basically, because at the end of the day, some of these budgets are pretty substantial.
It's unbelievable how many questions we get this today. So that means that it's a really interesting round. So from Christoph, next question, maybe that fits also to the discussion, and maybe Ries, you may answer it if you want. How do you evaluate your KPIs with the addition or transformation of other function than classical or traditional retail, for example, health, services, education, etc., which is also something necessary for the malls or for the big retail assets?
Could you just read that once more, please, just so I can get the answer right?
How will you evaluate your KPIs with the addition of transformations of other function than classical retail, like health, services, education, where no sales numbers are available, just to give you a hint?
Yeah, no, that's good. I mean, look, I would, incidentally, I'd probably start with the asset that I'm sat in here in Berlin. So, Gropius Passagen, the previous owners started on the very interesting and successful journey of transforming the upper echelons of a former Kaufhof into a medical center. And we have continued on that journey and continue to lease out more space to GPs and medical practitioners. And I suppose, yes, of course, there's no sales data to speak of there for obvious reasons. But what we can see is that there's obviously a byproduct of that customer turning up to our property, and it helps in terms of recurring visits. It helps in terms of spends in pharmacies, in the different health and beauty stores. So there's definitely a way for us to have a clear read across from categories that directly benefit from services like medical, for example.
Thanks for that. That's very important. So it's unbelievable. Time is running like hell, and we are very close to be finishing. So I have to spoil that. I have not started with my questionnaire. So the problem is we need to go to the final round. But I found out at that stage that this asset class is totally vibrant. So we have a lot of, let's say, details to discuss and to deep dive, and there's lots of transparency needed to make this retail class also in a long-term future resilient and robust. And I think that this is also part of our discussion. I would love to have a last round from you guys with my classical final question. What will be your best commendation, top three, when it comes to an improvement in our industry? What will you, let's say, comment to the audience, to your colleagues, to our competitors, however, to be successful in the future as well? Three commendation. We do it in alphabetical order. Henry?
Good idea.
Yeah, very good idea. Thanks, Klaus. No, happy to start. Look, to be honest, it's not something totally new, right? Eventually, and I think Toby touched on this, every catchment is different. Every customer is different. So first, for me, you have to understand, you and your tenant have to understand your local customer and your catchment, and then take the results from there. Secondly, it is engage, let's say, with your tenants in a dialogue on equal footing, right? And, have a partnership for success rather than it's us versus them. I think this is very important, especially, let's say, on a long-term relationship base, because both need to be successful in order, to have a win-win situation for the customer in the end. And third is, we talked about it. Look at the facts. Really look into it, and make up your mind and look at the transparency that asset class has to offer. Look at the track record, and I think then you will see quite a bright future.
Perfect, Henry. I'm really curious to hear what Ries will add to these three recommendations, or what his three recommendations are.
Well, my observations, many of them actually chime with what Henry's mentioned, but I think there's a lot of opportunities out there. There's a lot of stock that you can gain access to. So I think it's, first of all, ruthless. It's important that you're ruthlessly selective in terms of what you go after and buy. And in doing so, you've got to be super diligent, obviously, during the underwriting process, and look at sales productivity, occupancy cost ratios, historic performance, robustness of cash flows, and all that good stuff. Secondly, I think you've just got to keep honing in on the relevance of the property and the purpose of the customer journey, which will vary obviously from property to property. And then I think in terms of creating management-led outsized returns, if you will, I would focus on properties where operational intensity of management is required to drive returns. So those would be my three.
Super, perfect. Thanks for that, Ries. Stefan, your three recommendations in a short.
I think we've spoken a lot about numbers and data points and Excel sheets and yields. So I think I'd pitch it to a higher level for the response to this question. I think it's also mentality matter to have faith and confidence in the future. If you ask what helps us to work towards a positive and bright future, I think we have our head too much in dark clouds. I think we face a lot of regulation in every aspect, and it would be good to unleash creativity and innovation in the industry. That also means that sometimes you have to break the rules, or rules have to be changed, because otherwise you stay stuck where you are. I think that's not super helpful. And we need to embrace change and not try to get back to how it was. When we see the geopolitical situation, when we see the economic situation in many countries, when we see new technologies, I think we need to embrace change and collaborate with professional parties through that change process and be of good spirit.
Perfect. Thanks for that. And Toby, number 10 till 12 of our accommodations, what will be yours?
Very simply, Klaus, I think you got to be creative, be flexible, be diligent.
Perfect. What a great
Point access. That's the last one.
Thanks for that.
Sorry.
So what a great wrap up and what a great discussion. I have to thank you so much. And I'm afraid, Reinhard, as my questionnaire has not started, there will be a follow-up sometimes.
We need to.
I have to thank you so much for that great round. I have to thank to the audience for the number of questions which could not be raised all the time. So please apologize not doing all of these, but maybe there's a chance for next time. Reinhard, I hand over to you and hope to hear more what's coming next.
Okay, thank you, Klaus. So, gentlemen, what should I say? It was really a great, inspiring, exciting, and very informative discussion. Thank you for that. Time was too short, definitely. What you did, you provided me and you provided us, my editorial team, a lot of inputs for our next editorial work. So thank you for that. And as mentioned at the beginning, what we will do now is that we will work on a summary. We will send out this summary tomorrow with our newsletter, and we will also put this summary in the next print issue. Yeah, thanks again to you, gentlemen. Many thanks for the audience for watching us, and many thanks for the questions you raised. Great. Yeah, and we hope to see you again in one of our next across retail talks. We are planning to do 2 or 3 talks this year till December. Klaus, be prepared. Thank you for listening. Yeah, and goodbye and have a great day. Thank you.
Good luck and see you soon.
Thanks. Bye-bye.
Yeah.
Thank you.
Bye.
Yeah.